Okay, let's have a look at what happened over the last week. When we get to rates here, top of the screen, nothing. Hardly any moves at all. It's one of the lowest volatile weeks I've seen in over a year across all the tenors. The money market yields, the 1 month dropped 8 basis points, but almost no change. Well, we can go all the way up to the 1 year, just holding tight. Capital market rates have increased, but just slightly at the long end of the curve, basically unchanged as well. We have the FOMC in 3 days, rate decision in 3 days. We have the ECI, the Employment Cost Index, in 2 days. And when we look at what the Fed says they're looking at core PCE for services, less housing. That's no different than the labor market, because the biggest driver in services, less housing, is labor. So that's going to be a big number. We'll see if we can get some kind of clue from this, from personal income and personal outlays, which we got with the PCE report on Friday. And then on Friday, in 5 days, we get the jobs report for January. And given that continuing claims have been really, really low, we're going to have another month of job gains for February. Look at our curve inversions. 2 to the 10s now inverted 207 days. The 3-month to 10-year is 95 days. If we look at the Fed's preferred gauge, they look at the 3-month rate 18 months out less the current 3-month rate. And I'm using 3 months SOFR to get that done as a proxy for it. Inverted 138 basis points. Now this is an interesting thing here. Both of these, the 3-month to 10-year, the 2 to 10-year, have been inverted for more than 3 months. Both of them have a 100% track record of preceding a recession when they've been inverted for more than 3 months. So not every 2-10 inversion leads to a recession. Every 3-month 10-year inversion has led to a recession, but when the 2-year 10-year is more than 3 months inverted, 100%. So we have a bunch of inversions in the yield curve. Even across real yields, we have an inversion from the 5 to the 10 that has a 100% track record of preceding a recession, such that if we do not get a recession this time, it would be making history. Every yield curve would be making history if we do not get a recession. It's a big bet to make that we're going to get a soft landing and just stay there. Effective federal funds rate still sitting at 4.33. Let's see what happens after Wednesday. That's expected to increase to 4.58 or 25 basis points, but it doesn't have to be 4.58. Could be 4.6, 4.62, but somewhere between 4.5 and 4.75. Reverse repo is dropping, dropped by another 80, almost 87 billion, almost printing a 1 right here. Not that there's much of a difference between this number and 1.99999, but it is a psychological number that will make the news when the reverse repo drops below 2 trillion, because it's been there for so very long. Let's look at Fed balance sheet, down another 16.2 billion, down to 7.96 trillion. Hardly looks like it's moving, right? 7.96 trillion versus 7.977 trillion. 1 billion of T-bills have run off. Mortgage-backed securities, another 15.2 billion. Let's add M2 onto this. M2 year over year, because it's been getting a lot of attention, because this is the first time it's done this. So January 2nd, 23 versus January 2nd, 22. Just looking for 2022. Down 1.84%. It is the first time M2 has shown negative growth year over year through history. The first time. Contractions in the growth rate of M2 have aligned very well with tightening policy leading or leading up to recessions, because typically that is what has always happened in the past. That this is the first time it has actually gone negative. However, the M2, the money supply, increased so dramatically after the pandemic that this is, even after this contraction in money supply, if you take like a 3-year rolling average of the increase in money supply, the last 3 years is still dramatically higher than any other 3-year rolling period. So take it in context. It's a decrease from a level that we probably shouldn't have got to begin with. February 1st, the percentage for zero has actually gone up here, 0.7 to 1.6. Very, very small, but more people are leaning towards the zero that are using the Fed funds futures. And 25 basis points, 98.4. Down from 99.3. I don't see a zero happening. There is going to be a move. It's just a matter of, are they going to move 25 and talk really tough, or are they going to say the talking tough doesn't work for financial conditions, let's move 50 and really make our point. I don't know that they're going to use the interest rate to really make their point. I think the press conference is going to mean everything, but wouldn't surprise me to see 25 basis points and a lot more tough talk in the press conference. If this is not joined with any kind of tough talk at all, well then financial conditions will loosen even more, I think. For June, the weight is moving higher. We're moving up to the 5 and the 5.25. So the 4.5 pretty much is staying the same. Not a lot of movement at the 5.5. Let's cross those two off. 4.75 has dropped from 11.2 down to 8.4. The 5 is pretty much staying the same, and the 5.25 is up to 36 from 34. So there is more weight moving towards a higher terminal rate over the course of the year. Real yields still continue to drop, and we had slight increases in the nominal capital yields, decreases in the real capital rates, so you have an increase in the break-even rates, which seemed rather odd because the price data we got over the week suggested that inflation is coming in at a decent enough pace, yet here we are going the other way. Inversion from the 5-year to the 10-year was 8 basis points, is now 10 basis points. The drop in real yields is far more supportive for asset prices, and I've made that point before. And it's an easy way to see it is if you're forecasting cash flows and then discounting flat cash flows to get to a present value, and that is a discounted cash flow analysis. That is typically how you would value a company that has cash flows. If you use nominal cash flows, you discount with nominal yields. And nominal yields have the real component plus an expected inflation in there. Well, your cash flows, especially for equities, would increase at some level of growth of quantity over time, along with whatever price increase that you plan on. So they would grow typically at the rate of inflation, maybe higher than the rate of inflation, but for companies that could pass on price increases, they would grow at the rate of inflation, and then you're discounting at a nominal rate that has the expected inflation component in there. If you're forecasting real cash flows, you're really forecasting just a common price today with just a change in quantity. That is how much you will grow in real terms. Then you discount it with real interest rates. Well, if your real rates have been dropping over time, that is more important for the present value of those cash flows than the inflation expectation, because the inflation expectation increases the numerator while it increases the denominator. Whereas for real cash flows, the only increase to the numerator is in real terms. Real quantity has to happen, not just increasing your revenues just because you're increasing price. So decreases in real cash flows are supportive of equity prices because they make the present value of those real cash flows higher. The Fed funds futures bottoming out here, 95.095, implying a rate of 4.905 in June and July. Last week, doing the same thing, June and July, pretty much at the same level. implying a rate of 4.895. Here it's just 1 basis point higher. No change in what we think the policy range will be. End of year, pretty much the same area here, 95.455 versus 95.495. So the terminal rate at the end of the year up by 4 basis points, from 4.505 to 4.545. Not much of a change. 36 basis point difference from where the Fed fund futures would bottom to the end of the year. If we look at the forward 1-year rate, 1 year from now minus the current 1 year, we have an inversion of 98 basis points. 98 basis points last week as well. So this curve is inverted. The 1-year rate really follows where monetary policy is, and if we look at the 1-year rate 1 year out, that gives us an idea of where monetary policy will be in 1 year, and it's looking like it'll be 100 basis points lower than where it is now. December 2023 to December 2024, if we're using the 1-month SOFR, going from the end of this period to 2024, just to get an idea of what kind of rate cuts we would expect over 2024, 141 basis points over 2024. So roughly about 36 basis points of cuts, call it 2 rate cuts this year, and maybe as many as 6 rate cuts next year, being priced in to the futures market. TLT. No, I had no position changes for TLT. It's not really doing anything much at this point in time. Increased over the course of the week by 0.37%. The S&P was up 2.4%. Implied volatility pretty much disappearing. Wait till we see implied volatility on SPY. It is just gone. 13-week implied volatility 0%, down from 6. On the 26 weeks, it's 2%, down from 21. And on the 52, it's 5% down from 29. So selling puts on this is not as profitable as it was, and that is really what I'm trying to get done over time, is when it pulls back. It's not in a range where I want to sell puts. When it gets down to about 103 into the 101 range, there is where I will sell puts. And if it does get down to that range, hopefully the IVP will have increased. The level of volatility will have increased. Because right now, we're sitting at a 13-week low, and 98% of all observations of volatility have been higher in the last 6 months, and 95% over the last year. So that's a low level. So if we do have a pullback, this is where I would probably sell puts, because I still want to get cash neutral on the calls I bought. It is only January of 2023. These are January of 2024 calls. I basically got, if you count February all the way to next January to sell options, I got 12 more expiration dates that I can use. I'm in no rush. I will wait for the market to come to me when it's set up right. Then I will do it. But I'm in no rush to get cash neutral. I've already got about a third of it cash neutral as it is. So even if I have to skip February and skip March on the options, volatility will probably come back on these. Yeah, that's it for the screen. Okay, spreads, corporate spreads, all of them coming in again this week. This is really interesting. On the CCC, it has been the outperformer. If you look over the last, let's say 30, 60, 90 days, CCC has been the best performing category of credit. The category with the highest default rate has been the best performer. Think about that for a moment. So you have the yield curve, which is usually a recession signal, and we have many different inversions that we can measure, all of them inverted. And because of their depth and their duration at this point in time, you're talking about 100% track record on just that indicator. You have M2, which is a good indicator of a looming recession, actually for the first time becoming negative year over year. The third big financial metric to look at for an impending recession is corporate spreads usually widen in front of one. and it's not widening at all. It's going the other way altogether. Different sort of a shift on the curve here. If we look at the yield on investment grade versus high yield, on investment grades, all the yields have increased week over week, and on high yield, all the yields have come in, meaning over the course of the week you've had price decreases here versus price increases on high yield. Mortgages, this is getting to be an interesting market here. 6.13 down another 2 basis points. The 10-year week over week increased by 4 basis points. The 30-year fixed rate mortgage decreased by 2 basis points. So the spread between them decreased by 6, which is supportive of MBS pricing. So MBS has increased. So if we look at mortgage REITs, the assets on their balance sheet all got more valuable. It's going to be interesting to see their earnings for the quarter. Mortgage applications, after a big monster up week last week, follows it through with another 7% increase. Refis up 14.6, purchases 3.37. Building permits for December were down 1%. That's month over month. New home sales were up 2.3% for December month over month. Pending home sales for December were up 2.5% month over month. So this has been 2 weeks in a row where the housing data coming in is fantastic. Mortgage apps followed last week with another increase. You have new home sales that are increasing, pending home sales month over month that are increasing. Tuesday, we don't have much housing next week. Tuesday we get the housing price index, and of course every Wednesday you get mortgage apps. For home builders this week, and we have NVR on Monday and we have Pulte on Tuesday. D.R. Horton already reported earnings. Again, another great quarter as far as earnings were concerned. So housing seems to be sort of stabilizing and recovering at this point. I think the highs of the mortgage rate are in. I don't know that you're going to see higher than 7.08 at this point. I don't think this is going to run back down to the low end of the range, which is the 52-week low end, 3.55, unless you get a significant recession where the Fed has to cut rates. But I think this will continue its slow march downwards as volatility in both mortgage market and volatility in treasury market decrease. This spread should continue to tighten. All right, let's have a look at 2022 Q4 GDP. Came in at 2.9%. I think the expectation was for more than 2.9, but it came in at 2.9. And we know that GDP has 4 big components: C plus I plus G plus X minus M. Consumption plus investment plus government expenditure plus the trade balance. Let's start with consumption, 1.42. When we say 1.42, it's not 1.42%. It is, we get to 2.9 by adding 1.42 plus 0.27 plus 0.64 plus 0.56. How much of the 2.9% came from consumption? If that is the only thing we measured, 1.42. Goods, 0.26, services, 1.16. These will add up. Each layer here adds up to the number above it. And goods breaks down to durables, almost nothing here, 0.04, and non-durables, 0.22. The volatility of GDP, if we look at quarter to quarter, GDP does this kind of thing. So it has a volatility, is 1.72. We look at ratios. The ratio of the volatility of the consumer component of GDP to GDP is about 0.61. If you look at investment, the volatility of investment to GDP, it is 2.9, meaning that the volatility of this component of GDP is lower than the volatility of GDP, but for investment, it is almost 3 times the volatility. It is the most volatile component of GDP. So it is worth paying attention to when you get a GDP number to determine how much of an impact investment had. And there's 2 things you do not want to see in investment. You don't want to see negative investment and rising inventories. That is the worst combination, because that's the combination that precedes a recession, where investment drops off and inventories start building. So we have 0.27 here, and what do we get? We get the worst combination you can get with big numbers. Fixed investment, negative 1.2. Inventories, 1.46. Now, look at the contribution to the 2.9 that inventories has, 1.46. Look at the contribution of consumption. The build in inventories contributed for the 2.9 was a larger proportion of the 2.9 than all of the consumption category together. So 2.9 is not that exciting when you have negative investment and building inventories. From fixed investment, non-residential 0.09, which is almost non-existent. Residential negative 1.29. So we can say, well, okay, residential, I think we knew that was going on. But this, the inventory number, that one, you really have to say, well, look, yes, okay, if I build inventory in this quarter, it counts as GDP, as part of gross domestic product for Q4. But that is inventory that nobody bought. That is a build of inventory over December because the consumer is turning rather weak. And we can look at this number over here. This is real final sales to private domestic purchasers. And I have some numbers here. Q4 2021 was 2.6% on an annualized rate. Q1 was 2.1%, Q2 was 0.5, then 1.1, now 0.2. Look at it just falling off over here to the zero line. And this is sales to private domestic purchasers. So if you build inventory, there are no sales to private domestic purchasers. And this is falling off to almost nothing. Government is 0.64, breaking down between federal and state and local. From federal, we can look at defense and non-defense spending. And then we have our trade balance added, 0.56. Exports was negative, meaning you exported less, far less goods, but you exported more services for a net of negative 0.15. And imports added 0.71, meaning quarter over quarter, you imported less. Imported goods, 0.72, meaning we imported far less goods, but about the same in services. Okay, we got leading indicators last week for the US, and I wanted to put everything on one screen, but it didn't fit, so I overlapped it, but it's easy enough. I can take the top layer and just move the top layer down, and then when we're done, I'll move the top layer back up. How's that sound? So let's just move that chart off the screen. And let's do some reading here. Where are we? LEI for the U.S. decreased by 1% in December of 2022, following a decline of 1.1% in November. The LEI is now down 4.2% over the 6-month period between June and December, a much steeper rate of decline than its 1.9% contraction over the previous 6-month period. So you had a 6-month period where you had negative 1.9, followed by another 6-month period where you had negative 4.2. So that is accelerating. This 4.2 is important because it is past the negative 4% line, and we'll see in the chart below what the 4% line means. Every time a 6-month decline in LEI has exceeded negative 4%, you have had a recession. It is not just a recession signal anymore, it then becomes a recession warning. Let's see what other narration we have here. The U.S. LEI fell sharply again in December, continuing to signal recession for the U.S. economy in the near term. There was widespread weakness among leading indicators in December, indicating deteriorating conditions for labor markets, manufacturing, housing construction, and financial markets in the months ahead. Well, this is what the Fed needs to see. We've got to get the slope of the supply curve from being steeply upward sloping. It's got to start to rotate and become a little bit flatter, such that any increase in employment is not met with massive increases in wages. So deteriorating conditions in labor markets, in manufacturing, in housing construction, and financial markets in the months ahead. Meanwhile, the coincident economic index has not weakened in the same fashion as the LEI because labor market-related indicators, employment and personal income, remain robust. So when we're looking at, and here's the business cycle, So here's expansion, here's slowdown, here's contraction. Your leading indicators look ahead. It is looking to contraction. Your coincident indicators should point to this period where the slowdown does not mean things are negative. It means things are still growing, but at a slower rate. And then the lagging indicators should still say growth. What do we have here? Because labor market indicators remain robust. Nonetheless, industrial production, also a component of the concurrent index or the coincident index, fell for the third straight month. Overall economic activity is likely to turn negative. That's an important line, right? Is likely to turn negative in the coming quarters before picking up again in the final quarter of 2023. So let's bring this chart up here. Let's bring it back up. So here's the zero line, right? Anything, as soon as you drop below the zero line, you get one of these lines over here, these little black lines over here, which is a warning signal. Once you drop below negative 4% over a 6-month period, it turns into a recession signal. And every time there's been a recession signal, here's your signal, followed by a recession. Signal starts, followed by a recession. Signal starts, followed by a recession. Signal starts, well, what do you think is going to happen here? This is yet another, well, these are all leading indicators, and they're all pointing to a recession. Once you pass that negative 4% over a 6-month period, recessions typically tend to follow. It's because of the momentum behind it. So, these are, as I pointed out in the Q&A, these points right here, the beginning and the ending of a recession, are determined somewhere out here. This is the NBER. And they will, when the recession's, well underway or over, it'll be a headline saying the recession started at this point in time. They time it then. But before the recession starts, over here, you have recessionary conditions that are occurring and deteriorating economic conditions, which cause the Fed to cut rates. So rates are usually cut before the recession starts, which causes an inverted yield curve to uninvert before the recession. So the thinking is, well, it's going to uninvert before the recession happens. That's typically not the interpretation, is that you are in recessionary data and it feels like a recession, so the Fed starts cutting rates. However, the NBER doesn't date it till much later. So it isn't as if somebody comes out and says, aha, today is the start of the recession. You won't know what the start of the recession was for another 18 months to 2 years if it had already started. So let's say it started January 15th. Or in this month of January, you're not going to know for another 18 months. So these gray bars are revisionist thinking. It's not on-the-spot thinking, whereas these indicators reflect what's going on at that particular time, and the Fed responds to these particular movements, but is not responding to this particular movement right now because it's worried about inflation. Okay, a few more data points we got last week. This is the Federal Reserve Bank of Chicago, the National Financial Conditions Index. Really interesting thing going on here. It kind of looks like just a flat line with a little blip in there. But look at the current, this is the Financial Conditions Index, negative 0.37, and then the adjusted index. And it adjusts for economic conditions, saying given the current economic conditions, how tight or loose are financial conditions. Any negative number is looser financial conditions. Positive numbers are tighter. So look at 3 months ago. 1 month ago, financial conditions loosened. Previously 0.34, currently negative 0.35. So they are going the wrong direction. And what is interesting here is if we just zoom in, this is the index here. So if we move it to the very end of the, where are we? There it is. There it is. Negative 0.37 on NCFI, and the adjusted is negative 0.35. So let's move backwards until we find another negative 0.37. And let's see where that gets us to. These are, as the numbers get less negative and into positive, the financial conditions were tighter. So we're looking for another negative 0.37 3.5, 3.6, 3.6, 3.7. So nationally, for the NCFI, not the adjusted one, you have to go back to March of 2022 to get financial conditions as loose as they are now. All the way back to March. So in other words, financial conditions in the US are as loose as they were last March at the very beginning of the rate hiking cycle, but adjusted for economic conditions. Financial conditions right now are looser than they were in March. We got to find a negative 0.35 on the top number, and where is that? Right around there, February 18th. Before you really started any rate increases at all. That's where we are today when we look at financial conditions. And this is produced by the Federal Reserve Bank of Chicago. You think this thing is not going to find its way into the discussion at some point? They're going to be looking at financial conditions. They're going to be aware that financial conditions have been loosening since the start of the year. Capital market rates have already cut rates by some 40 basis points altogether. Leverage is increased because your level of equity value is going up as well. Let's look at Chicago. This is the National Activity Index, the Chicago Fed National Activity Index. And here's where we are right now, this final month. And it gives you all of the components: employment, unemployment, and hours. Anything above zero is, for the activity index, is considered above trend. Anything less than zero is considered below trend. So production and income, negative 43. Personal consumption and housing, negative 0.07. Sales, orders, and inventories, negative 0.01. Production and income being the biggest drag. Only thing holding it up here is your employment, unemployment, and hours, 0.02. But have a look at how, at the level that it's at, and have a look at the rest of the numbers here. It is lower than what we're looking at here all the way back. This is May of 2021, so we can pull this back to see when it would be lower. And this was the pandemic, this was February 2021, and what was going on there that brought it down. It's hard to see it at this level here, but everything was in expansion until you got to this past recession here. That requires a closer look to see what was going on at that point in time that it would have such a negative value. So this gives you a chart with inflation cycles. This is with business cycles. We can zoom in here as close as we can. And it tells you here, following a period of economic expansion, increasing likelihood of recession has historically been associated with a value below negative 0.7. And we're sitting down here at negative 0.33. So this is not quite signaling recession at this point in time. Both of these links for both of what I've shown you is in the description box. We had PCE as well, so let's have a look at something here for CPI, and we'll have a look at some components of PCE in a few seconds here. This is sticky CPI versus core sticky CPI. This is from the Federal Reserve Bank of Atlanta. And we've already had the CPI number, so I think we can zoom in on the more recent activity at this end of the chart over here. And let's just look at sticky CPI, and we'll take these off. This is 1 month annualized and 3 month annualized. And if we look at the numbers that we get for December, this is just taking the 1 month, in other words, the December over November, just the sticky CPI component and annualizing it, 5.6%. The 3 month annualized is 5.5%. If we take just core, because that is really the more important one, let's just get rid of CPI altogether and look at the 1 month and the 3 month annualized. Core sticky CPI 1 month annualized is 5.7%, and core sticky 3 month annualized is 5.3%. If we look at flexible CPI, just look at core flexible CPI, because this is the most price sensitive component of core. There's where you're getting your negative numbers. For 1 month annualized is negative 5.4. and 3-month annualized is negative 6.8. So we have heard numbers that, well, the last 3 months, if you take the last 3 months of CPI or the last 6 months of CPI and annualize it, it's already at 2% or below 2%. If you're looking at the core. That's because it's taking both the flexible and the sticky components. So the Fed has basically eliminated all the flexible components because it says we're not looking at core PCE. We're looking at core services PCE, which gets rid of goods. Goods are the most flexible component. And we're also looking at it ex housing because, well, housing is lagging and it'll fall off anyways. So it's really looking at the sticky components of core PCE less housing. So to look at just the core PCE and say, well, we're under 2% is missing the point. You have to look at core sticky CPI, and it's up 5.7 on a 1-month annualized, up 5.3 on a 3-month annualized, and then of course you have the flexible components below it, negative 5.4 and negative 6.8. So if you put those together, it looks like inflation is pretty much taken care of. But inflation embeds itself in the sticky components, primarily labor. And if you don't get it out of the sticky components, it will show up in the flexible components given enough time. So the number that they're paying attention to is probably closer to these numbers here, 5.7 and 5.3, versus a more naive reading of saying let's just take core and annualize it, or let's take just core for 3 months or 6 months so that it's less volatile and annualize that. They're probably making a big distinction between the sticky components and the flexible. And when you say core services X housing, really, what are you talking about here? You're really talking about nothing more than the labor market. So let's move over to PCE at this point, and I have the news release up here. Let's look at personal income and outlays, and we'll do some reading here, and then we'll go to table 1 and make some points here. The increase in current dollar personal income in December primarily reflected increases in compensation and proprietors' income. Well, it's that increase in compensation we're concerned about because we get an ECI report on Tuesday. That is the employment cost index. That measures wage inflation in its purest form because it looks at at the wage increases for the same jobs over a period of time, and it looks at increases in the benefits for that job over a period of time. It does not mix itself up with or confuse itself or complicate itself with the mix of the employment of the types of jobs being added. It looks at the same job period over period, so it has no effect. The mix has no effect on it. It is really just the payment for the job. And we're being told the increase in current dollar personal income in December primarily reflected increases in compensation. The increase in compensation reflected increases in private wages and salaries in both services producing industries and goods producers industries. So there's your wage inflation there, or there's some wage inflation there. 41.6 billion decrease in current dollar PCE in December reflected a decrease of 95 billion in spending for goods and a 53.4 billion increase in spending for services. This was in December. You actually had negative growth in personal consumption. What we saw in GDP was a 3/4 consumption component, which contributed positively towards GDP. But by the time you get to December, it's already turned negative, which I showed you on that chart, that when you get to the end of that chart, it's only like 0.2. Within goods, decreases were widespread and led by gasoline as well as motor vehicles and parts. Within services, the largest contributors to the increase were spending for housing, transportation, mainly air transportation, and healthcare. So let's go to Table 1. Table 1 gives us a high-level view of a bunch of things you can read down the side of the column. You have personal income, less personal current taxes will give us disposable personal income. Then from disposable personal income, you have your outlays. and you have whatever you didn't spend, you have your savings. So it's fairly easy to read if you read the lines that are closest to the legend here. Personal income, less personal taxes is disposable personal income. Taxes aren't available to spend, so you got to get taxes out of there. So if we're looking at disposable personal income, because that really is the only thing that matters, you come to the very far end of the page here, and if we scroll up, we see these are months for 2022, May, June, July, August, September, October, November. Let's go down to personal disposable income for December, 18,982. If we look at the month-over-month change and annualize it, it is increasing at a rate of 3.157%. If you adjust that for inflation to get the real increase in disposable incomes, it's up 2.5% on an annualized basis, month over month. Go down to our savings down here, which is 637.5, and take that as a percentage of disposable personal income. It's 3.36%, which is good because it was, I think, 2.4% the last time we looked. It was rather low. It's 3.36%. Personal outlays, 18,344. The month before was 18,383. So it was a drop. Personal spending dropped 2.58% on an annualized basis. So if you take the month over month and annualize it, that's negative 2.58%. It's not the incomes that will give us an idea of the contribution to GDP or the contribution to the economy. It's how much is going to be spent. And personal spending month over month annualized is negative 2.58% on an annualized basis. So we say our incomes, the disposable personal income, if you come up to line 32, 18,982, you can have 10 people making $100, and they can all get pay cuts, but more people get hired, and that number would increase. The aggregate of disposable personal income would increase in the economy. So that is an aggregate. We'd like to get some idea of how it's growing on an individual basis. So this is why we have the per capita amount at the bottom. Disposable personal incomes in a per capita basis. This 15,213 is the same 18,982 adjusted for inflation. So that is a real increase, total billions of change, $2012. So that is a real number based on what 2012 numbers were. Then you can look at per capita in current and chain dollars. So this 58 will use the 18,982. This 45 will use the 15,213. So let's look at nominal dollars per capita, nominal incomes per capita. Annualized is increasing at 2.66%. And on a real basis, increasing at 2.03%. Now, in case you think that's interesting, well, okay, that's a 2.03% increase in real purchasing power from our disposable income. But out of disposable income, look at your personal outlays. And in your personal outlays, look at item line 39, personal interest payments. This is May, 313. Look at all the way to December is now at 382. That's a massive increase. If we look at just the month over month from November to December, that is an annualized growth rate of 7.5%. So that if you took this number here, this 382, and said, well, what percentage of my disposable income is that? It is 2.02% of disposable income. So interest payments now are 2.02% of disposable personal income. And on a per capita basis, real annualized growth in incomes are 2.03%. So when you say, well, interest payments aren't buying stuff, interest payments are just paying interest on the stuff you bought, it's really not available for disposable personal income, even though it's considered part of your personal outlay. If you adjust for that, you have zero growth in real purchasing power in this sense. Where is growth going to come from in 2023? It's going to have to come from credit. It's going to have to come from credit, right? So some interesting numbers in this table over here. This is table 1, and then I think there are 10 tables altogether. This is the same table 1, but years and quarters. So you get just a larger view, and you're getting it by quarter as opposed to broken down by month. So if you calculate the change, you could do all those calculations again. You can take disposable personal income and you can calculate the quarter over quarter, and then just put that to the power of 4 to get what an annualized rate is. It'll have lower volatility than the month to month. So that's what table 2 is there for, to give you a less volatile number. And you can do it over a 6-month period. Take Q4 over Q2, and whatever the growth rate of that is, just square it, and you'll have an annualized rate. That'll give you even a lower volatility, or what's called a smoother number to follow as well. So you can do all those calculations for disposable personal income growth, for the savings rate, for personal spending over a 3-month period annualized, over a 6-month period annualized. And if you do it over a 6-month, then a 3-month, then a 1-month, you'll see it continually dropping. That over a 6-month period, you had an increase in personal spending. Over a 3-month, an increase, but at a smaller rate. And at a 1-month, you have a decrease, which is showing a deceleration of the consumer. Okay, let's jump right to earnings here. We've got some big events this week. On the economic front, we have Tuesday, ECI, the Employment Cost Index, and Friday, the Jobs Report. 2 big market-moving reports. On the financial front, you've got the Fed on Wednesday determining rates, and then the press conference. Overlay that with, what do we have here? 107 S&P 500 companies reporting earnings. So you're going to have earnings coming out before the bell, after the bell, Monday, Tuesday, Wednesday, Thursday, Friday. Nothing after the bell on Friday. Along with those 3 big event days, Tuesday, Wednesday, and Friday. So next week is going to be, again, day-by-day trading as well, depending on the tone of the earnings, what the economic reports say, what Powell is going to say. Let's go right to page 10 here. I think it's on page 10. This is on page, page 10, and Exhibit 15A. Notice the forward 4 quarters, Q1 2023 to Q4 2023, which is calendar year 2023. And the question was, how come these 2 are not the same? And I think that one of these are lagging by a week, which I think is the forward 4-quarter estimate is lagging by 1 week. S&P, we've seen that before. Their spreadsheet is more up to date because the 225.02 that we see this week was last week's estimate on the S&P. So let's use theirs. From now on, we'll just switch the S&P 500 spreadsheet. The reason I was using this one, it's just easier to get. It seems it's always available, where the spreadsheet for S&P, sometimes I can't find it. Even if I preserve the link, it just says there's nothing there. So it was hit and miss every week, it seemed, on the S&P. But I do have it up available for you, so let's click over to it. On the very first tab, there are a bunch of tabs along the bottom. Lots of information, by the way, a hell of a lot more information than the spreadsheet than you're going to get on the week in earnings, the PDF. Go to line item 92, the current estimate, and under D 2023, there's your estimate down there, is now 223.63 instead of 225.02, 223.63. And it gives you the evolution of the estimate at month end. So we're not at month end yet, so we're sitting at 223.63. December of 2022, December 30th was 226.49, so it's come down some $3 roughly since the end of December. If we go to the last tab, the forward schedule, it gives you all of the companies reporting. This is the January 30th to February 3rd. Monday, ATC is after the close, so if it doesn't have ATC, it's the morning. It's before the open and after the close. Gives you Monday, Tuesday, and you can scroll down. A lot more detail here, because rather than just giving you the ticker, It gives you the full name of the company in case you look at a ticker and you go, I don't recognize that ticker. Tells you what sector and what sub-industry they're in. For home builders, we have two. I've highlighted them for you. You have NVR and you have Pulte. But let's also look at building products and see what their forecasts are, because to build a home, you need building products. So let's have a look at that. You can see there are some REITs in there. There's residential REITs. There's two office REITs that are, there's another residential REIT over here. Two office REITs this week coming up. There's one up here, which is Alexandria, and Boston Properties is in here somewhere. My eyes are scanning. Oh, there it is right there. Boston Properties, which is a huge one. Two office REITs. So if you're in that space, that's there as well. Household appliances may be interesting to look at, because typically when a new house is built, appliances are added. So we'll see what Whirlpool has to say after the close on Monday. And then Tuesday morning you have A.O. Smith, you have building products there. I'm not too sure what they build, but there it is. And if you scroll down past this, you get the week after. So you can see who's reporting the week after that. And if you scroll down, you get the week after that as well. So you get a lot more information with this one. You get your whole monthly calendar here at a glance. So you can see exactly where we happen to be. January 23rd, 24th, 25th. Where are we now? We're 29th, so we're looking at January 30th, right? So January 31st, there's the two-day FOMC meeting. There's the big one right there, the Employment Cost Index. You'll get the Case-Shiller Housing Price Index. February, we get the Always Wrong ADP. You get some PMI numbers, ISM Manufacturing. JOLTS for February 1st. Forgot to mention that. The JOLTS data is coming out. So for the month of December, we'll see job openings and the quits rate. And then here we are on February 3rd with the employment report. This will be interesting too, productivity and cost. I know I haven't hit the economic calendar yet. I'm just, this is just stuff that's popping out to me right now. Productivity and cost will be important. I don't know if it's going to have the same impact as the employment cost index, because once we get to productivity and costs, if you have the employment cost index, you can almost figure out what productivity and costs are going to look like, because if you have output and you have wages, you can pretty much get to those calculations on your own. So I'm not sure there's going to be anything incrementally new in this report, but there it is. So let's use some information in our levels for S&P, because we are now over 18 times earnings on the index. All right, let's have a look at our SPY levels. I was going into the week negative short. I should clear that up when I say negative short. So I have a number of portfolios. So we're just going to talk about the taxable portfolios I have. I have one that's roughly about this size, one that's this size, and I have external money with external managers that if we're going to draw out proportionately is about that size. This is long only. There's nothing I can do about that, because external managers basically are just long only, and this is a mix of a lot of things. There's 25% AI, 65% is equity, and 10% fixed income. Fixed income is split between Canadian government bonds and Canadian high yield. AI is split between private commercial real estate and hedge funds, and the equity is primarily global equities, with a big chunk of it, I think half of it, is small cap. It's long only. These are the two taxable portfolios I have, which are negative short dollar delta beta. So overall, when you combine everything, and there's also TFSAs and RSPs and liras in there as well, that overall I'm net long. It is within these two portfolios that I am net short, but my exposure is still net long. If I tried to get net short, considering the size of this, I would be concentrating way too much risk into these little guys. So if there is a sell-off, I will do okay over here, but this will still drag me down. Closing four-quarter EPS here is 223.63 versus last week at 225.02, closing SPX 4070. That puts us at 18.2 times forward earnings. The June ES, which is the June S&P mini contract, closed at 4118.75. You can see the difference of these two, so you can see there's 48.19 points of carry. Since ES is for 50 times the index, you multiply that by 50, there is the carry that you have, 2409.50. My average cost on ES now, or my average short, I shouldn't say my average cost, my average short price is 40.80.80. Last week on, I think it was midweek, the S&P opened and went negative, and the June contract fell all the way to 4,000, and I had covered some positions at that point. Then it rallied throughout Friday, and only at the my last short on Friday was at 41.40. I grabbed some at 41.40, and in the last 15 minutes the market really sold off and finished at 41.18. Some 20-25 points came off the index at the end of the day, which was nice. It helped out at the end of the week. Let's put this 18.2 into some context here. The earnings yield is 5.49%. The 6-month T-bill pays 4.81%. So you're getting less than 70 basis points of compensation for taking on risk. In 6 months, you are going to get 4.81% return on whatever the principal amount of T-bills that you're buying. You have an earnings yield of 5.49% here, which means you got, what, 68 basis points of premium to take on risk, which means, sure, it could be a lot higher, but it could be a lot lower. This is guaranteed. So you're going from guaranteed to highly uncertain, and you're only going to get an extra 70 basis points of expected return. You may not even get that. It's just expectation. You can go to a 1 to 3 year investment grade bond, which you're pretty much going to get as well, 5.05. So to go from, in the capital structure, because this is the multiple on S&P 500, these are primarily all investment grade, to go down in capital structure from basically close to, nothing is guaranteed, but it's pretty much, you're going to get 5.05. 44 basis points of compensation to go from the capital, debt in the capital structure down to the equity. There you have the uncertainty of not knowing what you're going to get, and you're only being compensated 44. So by these measures here, you're just not being compensated enough. 44 basis points for the risk premium from investment grade over to equity, and from risk-free over to equity, you're 68 basis points. When we think, an equity risk premium, if we're talking about investment grade types of companies, maybe you don't want 450 points, but at least 300 points, you're getting 68. So by that measure, based on where treasury yields are at this point in time, this is a relatively overvalued market. High yield will give you 8%. S&P, just to give you some idea, yes, we're at 18.2. By relative measures of yield, we're overvalued. The SPY is now over its 200-day moving average. It's over its 50-day moving average. And see this downtrend? It is now above the downtrend. I don't really like the idea of saying, well, the S&P broke out above its downtrend, because whenever the S&P is rising, you can draw a line. And if it breaks down below that and starts to rise again, you draw another line, then another line, and then you keep drawing lines. These are called speed lines, so that the uptrend is here, which should offer support. But it was here, then it went here, then it went here. So when we say that it broke out above the downtrend, all you're going to do at this point in time is you draw another downtrend. So let's do that. We need a thinner line here. Let's get white, and we just draw another downtrend. So technically, the S&P 500 is at resistance, right? This is the thing I don't like about drawing lines on charts, is every time the price moves, you draw new lines on charts, and well, there you go. You're never breaking out, because no matter where it goes, you're always at resistance. I'm not comfortable with all of those thoughts. But if this estimate here of earnings does not change, this will always be 19 times. That fundamental level will always be there, but the technical levels change every time the price changes. So this is why I'm not a big fan of technicals, because if they change as the price changes, why do I need to look at something that's changing as the price changes? Why not just look at the price change and ignore all the things that change as the price changes? Or look at the price change in relation to something that is a lot more solid, like a fundamental level. Anyways, that's my criticism of it broke out above that, above the downtrend, only because that was the line. There's a new line now, so in essence, it has not broke out above the downtrend. It can never break out above the downtrend, because every time it does, you draw a new line, and well, there's a new downtrend. So all that's going to happen now is, well, we have a new downtrend. 17 times brings you down to 380. 16 times brings you down to about 357. Look at the volatility here. It's basically gone. 13-week implied volatility percentile, 0. It means all observations of implied volatility over the last 13 weeks were higher. All over the last 26 weeks were higher. And only 2% of the observations in the last 52 weeks were lower than where we are now. And the last implied volatility was 16.4. When you have it this low, you tend to switch to buying puts rather than selling calls. You'll buy puts because they're just really cheap. And if the market goes down and volatility increases at the same time, you get two benefits. You get the delta move on the way down, and you get the implied volatility move that increases the premiums as well. So you actually the premiums on the puts actually increase at a faster rate. The put call ratio just on Friday alone was 1.15. So 115 contracts on the put for every 100 contracts on the call. The open interest put call ratio is interesting, 2.07, twice as many puts as there are calls. So what am I doing at this point in time? I'm not buying into this rally. Every week we've had earnings just doing this. You have inversions of almost every yield curve. You have shrinking money supply. You have a job market that is super tight, and the Fed recognizes that. You have sticky components of core CPI, which are still elevated. That is not going to be lost on the Fed. You have leading index indicators already in recession territory. You have recessionary signals in other parts of the market as well. You have corporate earnings that were at a record corporate earnings as a percentage of GDP, and you have zero, almost flat growth in the consumer in terms of what they can spend when you adjust for how much of their disposable income goes towards interest. Where is growth going to come from? I'm sort of lost on that one, because to think that the market is going higher must mean there is more growth. That's the only way it goes higher, is with more growth. And I'm just not seeing where the sources of growth are coming from. The Fed is not going to go to 5%, wait 2 months, and then just start to cut because inflation looks like it's going away. They've made that very, very clear. And right now it's all about the job market, and there's no slack in the job market. You get any return of purchasing power. And if you've got to add employers, you're going to have that wage increase right away. You're going to have inflation come right back all over again. So it's just based on a constellation of a whole bunch of things. I'm just not seeing how you're going to get an acceleration of growth without an acceleration of inflation, which will result in higher interest rates. And if we have an economy that flat lands, it's not going to grow. Let's say we don't get a recession. It will be stagnant. Stagnation is terrible for earnings. because they just do a slow bleed over time. So I'm fairly confident in my position, being short the contract, and as the market increases, I will add to that short position. But as I explained in the Q&A, which I posted late last week, when you are short the market, this is not a strategic position. Strategic meaning it's a long-term position that you would hold. So if you say I'm 60% equities, 40% bonds, that's a strategic allocation that you would tend to be 60% in equities, 40% in bonds. Tactical means you're going to move in and out on a more rapid basis. So any short position rarely is a strategic position unless you're a hedge fund that is a net short hedge fund. Then being short is strategic for you. So being that it is tactical, you have to trade it. You can't just short it and say, well, I'll pick it up in 6 months and see where we are. So the market will do this, and whenever it does this kind of thing from day to day, this is where you lighten up on your short position. It goes back up, you re-add, and you lighten up, you re-add. So if it's doing this, right, this kind of thing, and it just keeps going higher, you're adding, lightening up, adding, lightening up, adding, lightening up. Now, you don't know that you're grabbing the tops and the bottoms, but you should always be ready on pullbacks to say, well, let's lighten up a bit, let's add a bit more on the way up, let's lighten up a bit on the way down, so that the average short price you have, if the market is going up, your average short price should continue to increase as well. I don't know when the market will break, or if it'll happen this earnings season, or if I'm going to have to wait into March before it's going to happen. But I do have patience, and right now I do have conviction that I am on the right side of this particular trade by being net short the S&P right now. Okay, with that being said, we'll end here this week, but let me end with this message, and it's a message I put out before. Don't try to copy me. What I'm doing when I do these is I'm showing you the way that I think about the market from a very top-down perspective. You'll note that we always start with rates, and we start with rates because when you're determining the value of any asset, those rates, those par rates, are in the denominator of everything that you're trying to find the present value of. So you always start there to determine where they're going. And then you move out to other factors from a very top-down perspective till you get to the level of the market, and that helps inform you of the beta exposure that you want. Also informs you of the the duration exposure that you want. The two big risk factors in the market, duration and beta. And then from there you can determine from the market what sector you like based on what's going on in the economy, and from the sector maybe there are certain stocks that you expect will outperform. When I take a position, it's because it has an effect at the overall portfolio level. It's not just because that position is going to have some outcome and that's it. It is because that position has some effect on the entire portfolio. My exposure in my portfolio may be very different than your exposure, so that a short beta in your portfolio, if you're wrong, may hurt you, but if I'm wrong, does not necessarily hurt me. So this is really to show you a more rational approach to the market, as opposed to listening to this person, listening to that person, that you have a structure in which that if I disappeared tomorrow, you could replicate this entire structure, a structure in which you can think about things that you hear and ask, does it make sense in the context of everything that I know? So that you don't end up just listening to somebody saying, buy this, buy that, this is going to the moon, this is going up, buy this, because that usually never works out for you. This is meant to set you out on a path so that you can start thinking about what other people say and judging whether or not for you that makes any sense, or whether or not what the person said makes sense in the context of the bigger picture of what's going on. I share my positions ahead of time because I want to show you the power of what I do. So if you go back over the past 2 years and look at all the videos that I put up and all the things I said I was doing and the predictions that I've made, I don't think I'm bragging by saying that I was about 95 to 98% correct in the predictions that I made and in the positions that I took. I think my biggest mistake was GM, holding GM for too long, thinking that it just couldn't get any cheaper. And it kept getting cheaper. That one is going to take a while before it leaves my memory banks, but it's there. So when I do that, when I put this out ahead of time, it has much a different effect than saying, hey, over the last year I did this, and telling you after the fact what I did. I put it out there ahead of time, and let's just see what the market does. So that you can see that having a structure to your thinking, going through a process every time before you take on a position, going through that process does matter, because you end up in a position looking at what you want to do and saying, is that consistent with what I believe about the economy, what I believe about the Fed, what I believe about earnings? Is doing that consistent with everything I believe? Because sometimes people take on positions where they believe something about the economy, but you look at their position, you say, well, if you believe that about the economy, why would you ever do this? So you don't really have a lot of structure to what your thinking is. So that's what this is. It's really meant to show you what structure and process can do for your portfolio, what it can do for your thinking, and how it can keep you out of trouble and keep you consistent with what you believe in. And by the way, everything that I've talked about in every single video, everything is from the pages of the CFA curriculum, level 1, level 2, level 3, that by the time you get done level 3 and you go through one of these market outlooks, you should say, we covered that, we covered this, we covered that, we covered this. It's just when you read something in a textbook, and I'm going to draw something in the top corner of the screen, there is your textbook right here. And when you look at the real world is like this. Yes, there are some things on the pages that pretty much are the same as the real world. But there's a lot in the textbook that when you go to the real world, you go, wait a minute now, that isn't exactly the way I read it. It is somewhat like the way I read it, but it's not a direct correspondence to what's going on in the market, that some things don't translate well. And that's what these kind of videos are meant to do, is to say, well, you learn all of these little things. That's a terrible color on black, right? You learn all these little things on pages of books. And when you bring them to the world, they kind of look a little different. They look like this. And the Applied series does that as well. The Applied series is sort of a completion portfolio. If you want to use some level 3 terminology, a completion portfolio that takes you from book learning to street smarts. So that's really the big value of these videos, is to give you that process and to show you how you can take stuff that you might have read or learned in a textbook but never actually applied in the market, and was wondering, well, how would that even work? And why do we even care about things like Fed funds futures? What's the use of par rates anyways? And that's what this is about. The positions that I put out there ahead of time is really to show you what I take away from it, and I believe it adds some legitimacy to what I do. I mean, what would be the point of doing all of this if you still can't actually do it in the real world? And I think if you're pursuing the CFA designation, I think a more critical thing to ask your teacher, or whoever you select to be the teacher for the CFA courses that you take, is, do you do this in the real world? Not did you do it 20 years ago, but do you do this in the real world? Can you do this in the real world? And show me. Show me that you can do this, because I want to know that the person I'm listening to actually puts money on the line based on what they say on a daily basis. And if you don't, well, aren't you just really repeating the book to me? I mean, I can read the book. I don't need you. I need you to tell me what's in the book, how I can understand the book, and how that actually moves into the real world. Complete that step for me. And if you can't complete that step for me, well, thanks for coming out, but I'll keep looking. Okay, let's wrap it up there. That's another week. We got a lot coming up this week, so don't get out over your skis in front of any of these things. Don't underestimate the power of the ECI, the Employment Cost Index, because right now the only inflation gauge the Fed is really looking at, they've distilled it all down to that big fat labor component. Keep your eye on that.